The Share Pickers Podcast with Justin Waite.
On Tuesday, the AIM All-Share Index in the UK, which is largely startups, new companies, was at a new low. It hit 755 from its all-time high. The previous low was on Monday. The previous low before that was on Friday. Then previous to that, it was in October. Now, on Tuesday, the AIM All-Share had been down 9 trading days in the previous 10. It was down for the last 7 trading days and down 21 out of the last 30. The relative strength index, which is a measure of strength, momentum, was at 14, and 30 below that is considered oversold. Now, if you go back several years, the AIM All-Share has only gone down 8 days in a row, a handful of times. So what's the chance of this happening again? And it's only gone below 14 on the RSI 5 times in the last 10 years. 5 times in the last 10 years. So, there's a good chance the AIM All-Share would have gone up yesterday. And what happened? It went up a little bit. Went up by 0.13% to 756.6. So, there was a good chance. I say there was a good chance it would go up because it's all about probability. And when people say, is investing gambling? And they say it's not. Yes, it is. It's all about probability. You are basically betting on the outcome of a company's future. Will the earnings get better? Will good news come out? It's all speculation on future news. Now, if the All-Share AIM Index went down another day, there's an even greater chance of it rising the next day. It's essentially like waiting for the ace of spades to come from a pack. If you're, say you're playing 21 or blackjack, whatever it's called, at a table in a casino, and you are waiting for the ace of spades to come out. It hasn't come out for like 4, 5, 6 hands, 7 hands, 8 hands, 10 hands. You realise the chances of it appearing get greater and greater as you get towards the end of the pack. This is the same with bear markets. The average duration of a UK bear market is 19 months. With recessions, downturns, it's about 22 months. So we're now 491 days since the bear market started on AIM. That's 16 months. I mean, that's since the bear market started. That's what I mean by a 20% drop from the high. The closer we get to the average, which is 19 to 22 months, depending on whether there's a recession or not, the more likely we are to be coming towards the end of it. So, to finish this little podcast off, here are 10 facts about bear markets. Number 1, watch for 20%. Market cycles are measured from peak to trough, so stock index officially reaches bear territory when the closing price drops at least 20% from its most recent high. 2, stocks lose 35% on average in bear market, but by contrast, stocks gain 114% during a bull market. Bear markets are normal. This is point 3. There have been 27 bear markets in the S&P 500 index since 1928. However, there's also been 27 bull markets, and stocks have risen significantly over the long term. 4, bear markets tend to be short-lived. The average length of a bear market is 292 days. I think that's including the COVID dash for cash crash, which was very short indeed. And so that skewed the average a bit. So it's a bit longer than that. Normally it's about a year to 2 years. Maximum 2 years, pretty much. Significantly shorter, by the way, this is, than the average bull market, which is around 992 days, or 2.7 years. Again, I've seen those figures vary. Generally, in your head, think 1 to 2 years or 18 months, say, for a bear market, around about 5 years for a bull market. Number 5, every 3.5 years. That's the long-term average frequency between bear markets. Though, many consider the bull market that ended in 2020 to be the longest on record. The bull that ran from December 1987 until the dot-com crash in March 2000 is technically the longest. A drop of 19.9% in 1990 nearly derailed the bull, but that just missed and the bear's threshold there. 19.9% it went down to in 1990. 6. Bear markets have been less frequent since World War II. Between 1928 and 1945, there were 12 bear markets, or one about every 1.4 years. Since 1945, there have been 15, which is one every 5 years. So that's the change, you see. So since 1945, it's pretty much one every 5 years. Number 7. About 42% of the S&P 500 index strongest days in the last 20 years occurred during a bear market. Another 34% of the market's best days took place in the first 2 months of a bull market, before it was clear a bull market had even begun. Think about that. Some of the big up days are the vicious, seesaws or swings during a bear market. And then the start of a bull market, that's when it gets going. So in other words, the best way to weather a downturn could be to stay invested, since it's difficult to time the market recovery. 8. A bear market doesn't necessarily indicate an economic recession. There have been 27 bear markets since 1929, but only 15 recessions during that time. Bear markets often go hand in hand with a slowing economy, but a declining market doesn't necessarily mean a recession is looming. Number 9. Assuming a 50-year investment horizon, you can expect to live through about 14 bear markets, give or take. Although it can be difficult to watch your portfolio dip with the markets, it's important to keep in mind that downturns have always been temporary, part of the process. And 10. Bear markets can be painful. Telling me they can. But overall, markets are positive a majority of the time. Of the last 94 years of market history, bear markets have comprised of only 21.6 of those years. So to say that again, out of 94 years, bear markets have comprised of only 21.6% of those years. Not percent, 21.6 of those years. Put another way, stocks have been rising for 77% of the time over that 94 years. So the odds are in your favour if you hold stocks for a longer period. But of course, it depends what stocks you hold.
The Share Pickers Podcast with Justin Waite.